Most dividend investors spend their time looking for the next position to add. They scan yield screens, read analyst reports, check payout ratios, and build watch lists of companies they intend to research more deeply when they find the time. What they almost never do, and what produces more portfolio damage than any bad stock pick, is pay close attention to the dividend increase announcements already arriving from companies they already own. Because the way a board chooses to increase a dividend, the size of the increase relative to the cash flow supporting it, and the capital allocation language surrounding the announcement tells you more about the next 3 years of that position's performance than any new stock idea you could add to the list. There are 4 companies that just announced dividend increases, and the differences between them are not small. The S&P 500 is approaching 10% year-to-date as we move through 2026, which would make this the 4th consecutive year of double-digit returns. That context matters before evaluating any dividend increase announcement, because the valuation environment surrounding these 4 companies is not neutral. The index is trading well above its historical valuation multiples, and historically, forward-looking returns have not been strong from this valuation range. The one genuine caveat is earnings growth. JP Morgan projections show earnings per share growth picking up dramatically and continuing to strengthen in the coming years, which would warrant higher multiples if it materializes. Growing earnings lead to growing free cash flow. Growing free cash flow leads to growing dividends. That chain is why these 4 announcements matter, and why the quality of each announcement is worth examining carefully rather than taking at face value. Fastenal just announced an 8.3% dividend increase. On the surface, that is a strong number. Over 5 years, the stock is up 76.8%, and year-to-date, it has already returned 17.11%, better than the index. The business model behind that performance is specific and worth understanding. Fastenal distributes industrial and construction supplies, fasteners, safety products, tools, through vending machines and on-site locations embedded directly inside customer facilities. 43% of revenue comes from heavy manufacturing, another 32.8% from other manufacturing categories. This is an industrial business whose results are directly tied to factory activity and production volumes. When manufacturing is strong, customers consume more product. Revenue per share has grown consistently for over a decade, essentially doubling over that period, with the debt-to-assets ratio remaining as low as 8.75%. The capital allocation policy is unusual and worth understanding before treating the yield as a standard income position. Fastenal distributes the vast majority of its free cash flow as dividends, including special dividends in years when free cash flow is elevated, as it was in 2020 and 2023. In years when free cash flow is lower, distributions decline accordingly. The current starting yield is approximately 2%, which is not the attraction. The attraction is the quality of the business and the commitment to returning cash. The valuation, however, deserves attention. The forward PE multiple is currently 37.27, approximately 12% above its 5-year historical average of 33.24. This is a high-quality business at a premium price, which is not inherently a problem for long-term holders, but is a context every new buyer should price into their expectation of forward returns. Enterprise Products Partners announced a 1.8% dividend increase, and that number requires more careful interpretation than the announcement alone suggests. A 1.8% increase in an environment where inflation is running above that rate means the real purchasing power of the distribution has technically declined. That is not a headline the press release led with, but it is the mathematical reality of a below-inflation increase for income investors whose cost of living is rising. That said, EPD has performed exceptionally well over the past year, up approximately 20% in price. And as of the start of 2026, it was still yielding over 6% even after that appreciation. Before entering 2026, the yield peaked near 7.15% in November 2025, representing one of the more compelling high-yield opportunities available to income investors at that time. Understanding why the increase was only 1.8% requires understanding what EPD actually is. This is a master limited partnership, an MLP, and the correct framework for analyzing distributions from an MLP is distributable cash flow per share rather than reported earnings. The projected distributable cash flow per share for 2026 is $4.15 against distributions of $2.26, meaning the distributions are extremely well covered by the cash actually generated. The question is not whether EPD can afford a larger increase. The question is why the board chose not to make one. The answer is visible in their 2026 investor presentation. The company is signaling an inflection point toward excess cash flow deployment into unit buybacks and debt paydown rather than distribution increases. Unlike a pure dividend maximizing business, EPD is actively strengthening an already strong balance sheet. It carries the highest credit rating in the midstream space with low leverage ratios relative to peers. Short interest sits at just 0.76%. Analysts are projecting 9 to 10% price upside from current levels. The EV to EBITDA multiple is slightly above historical average, but not significantly so. This is a conservative high-yield opportunity where the modest distribution increase reflects capital allocation discipline, rather than any weakness in the underlying cash generation. The yield on cost for investors who entered before the 2026 price appreciation is approaching 10%, which is the full picture of what patient positioning in a well-covered high-yield MLP can produce. Levi Strauss just announced a 14.3% dividend increase, the largest percentage increase of the four announcements, and the stock is up 17.29% year-to-date, after bottoming near $13.50 in 2025. Over 5 years, the picture is less flattering, down approximately 15% from the $30 range. The recent momentum is real. The full year 2026 revenue and EPS outlook was raised alongside the dividend announcement. Analysts are projecting double-digit earnings growth over the next 2 to 3 years, and the forward PE multiple of 15.78 combined with that projected earnings growth is genuinely interesting from a valuation standpoint. The 14.3% dividend increase reflects management's commitment to changing the capital allocation priorities that define the company's recent underperformance. The concern is in the free cash flow history. It has been choppy, inconsistent, and unreliable in a way that the income-oriented investor building a long-term position needs to understand before treating the dividend growth rate as a structural signal rather than a cyclical one. Short interest of 7.42% means a meaningful number of informed market participants are actively betting against the position. Analysts project approximately 15% upside from current prices, which suggests the opportunity is real, but also that the risk is being actively priced by the short community in a way that the other three announcements are not. The short-term setup looks relatively strong. The long-term durability of a consumer apparel business competing in a category with significant fashion cycle exposure is the question that the dividend growth rate alone cannot answer. Ryder just announced an 11% dividend increase, and the stock has returned over 53% year-to-date. The first question that return demands is whether it is earnings-driven or multiple-driven, because the source of a 53% price appreciation matters enormously to how much runway remains. In Ryder's case, it is primarily multiple expansion. The trailing 12-month PE moved from 14.93 and at its October 2025 low near 13.59 to 22.23 today. The market has assigned the business a significantly higher valuation, and the question is whether the underlying business has improved enough to justify it permanently rather than cyclically. The answer from Ryder's own data is more compelling than the multiple expansion alone would suggest. This is a truck leasing business. Capital expenditure is high by standard free cash flow metrics because buying trucks is the capital investment that generates future lease revenue. Growth CapEx, not maintenance CapEx. Operating cash flows from the core business have grown steadily from $1.7 billion in the strong freight market of 2018 to $2.7 billion in 2026, which is the structural improvement the market is now pricing. Return on equity and comparable earnings per share are both significantly stronger than the 2018 peak. The earnings payout ratio sits at just 27%. The 2026 free cash flow forecast of $700 to $800 million against dividend payments of approximately $145 million last year shows coverage that is not just adequate, it is substantial. The starting yield at current prices is approximately 1.4%, which makes Ryder a dividend growth story rather than a current income story. The 5-year dividend growth rate is approximately 10%, and this most recent increase at 11% is consistent with that trajectory. The forward PE of 18.39 remains below the S&P 500 average despite the significant price appreciation, which reflects either continued undervaluation of a structurally improved business or the beginning of a multiple that has already run its course. The business data supports the former more than the latter. 4 announcements, 4 different stories. Fastenal is a high-quality industrial business at a premium valuation, returning the majority of its cash flow through a variable dividend structure that rewards shareholders when the business is strongest. Enterprise Products Partners is a conservatively managed high-yield MLP with exceptional distribution coverage, choosing balance sheet strength and buybacks over a larger increase. Levi Strauss is a turnaround with genuine momentum, a compelling short-term setup, and a free cash flow history that requires more consistency before it earns the trust a long-term income position demands. Ryder is a structurally improved business growing its dividend at double-digit rates from a payout ratio that leaves substantial room for the trajectory to continue. The dividend increase announcement is not the news. What the board decided to do with the cash that could have been distributed and why is the news. And those four stories are not the same.